Hey everybody, this is Colin podcasting about real estate and welcome to show number 11. So get this, most people understand the world of rental properties, of house flips and other common real estate investments, but there is another little known niche that could provide strong cash flow and lots of profits without the headaches that I invest in personally, and that is note investing. And so my guest today is Dave Van Horn, the CEO of PPR Note Company and author of a really good book called the Real Estate Note Investing Book that he published with Bigger Pockets. Dave's been investing in real estate for more than 30 years and is an expert in the area, and he's a really fascinating and gentlemanly guest to have on the show. Before we get into that, I want to remind people that my website has been up and running for several months. It is colininvestments.com, COLIN investments.com. You'll find a bunch of real estate reports, real estate videos, links to all of the other podcasts I've done. If you sign up to any of the reports or get in touch with us, you'll be added to my email list and you'll get exclusive content that way. You'll also find links to schedule a call with me on that website if you want to have a chat about your own real estate goals or real estate investing questions. I'm very happy to do that. So check it out, colininvestments.com, and you'll also find links to where I am on social media there as well. So during this conversation with Dave Van Horn, we discussed how his single mom raised a family of 6 kids in Pennsylvania, how he always juggled multiple businesses during his early career, and he still does, how he used creative financing to build a rental portfolio using practically none of his own money, how investors and realtors use the MLS before computers were around. I was interested in that one. How he used note investing to pay for his kids' college tuition. That was a really good example, and the way he did it is something that anybody else can do. We talked about, the differences in note investing, buying first and second mortgages, performing and non-performing notes. We didn't go into too much detail, but we talked about them a little bit. We talked about the potential surge in mortgage defaults coming at us and how that's going to affect the market. And obviously, being one of the biggest mortgage investors in the US, the mortgage market is something that Dave is watching extremely carefully. And we finish up by talking about the resources people can use to educate themselves on note investing. I personally think it's a really good balance to have between investing in notes and investing in real estate. I do both. And, most people think about debt as something that just comes out of their bank account, but you can also be the bank. You can receive payments from loans that you've made, and that can be with a big fund or it can be on a mortgage that you own. I mean, there's lots of ways to be involved in the lending space, and it's a lot easier to be on the receiving side than the giving side, and it's just a nice balance to have with real estate. So check out this podcast. I think you're going to enjoy it, and let's go and see what Dave has to say. Dave Van Horn, how you doing? Welcome to the show.
Good, doing great. How about yourself?
Oh, I'm awesome. I'm awesome. Thanks a million for agreeing to come on it. I've been a fan of your work for a few years. I think ever since I heard you on a Bigger Pockets episode 6 or 7 years ago. And you've had a fantastic career and an interesting trajectory in real estate and real estate note investing. But for our listeners who, can we rewind back a bit to the beginning of your journey first? Can you tell us a little bit about your early background, where you grew up, and how your initial interest in real estate developed?
Oh, wow. Uh, yeah, I was raised by a single mom with 6 kids. And
Wow.
so I had my first job in 4th grade. I would get up at 4:45 in the morning and deliver the paper and all that good stuff. So but my mom, she's the one that got me into real estate. I finished college. I was working in
Mhm.
construction. I couldn't get a job. And I had actually moved back home I was married and had a son, and was living with my mom and working in construction, and I couldn't seem to get a job in my field.
Mhm.
And she said, why don't you try real estate? And I was about 26 at the time when I first went to get my license, and been a realtor ever since. And so that's how I got started. I came from the agent side of the world, and then I was working
And
towards
this
my.
was when, to give us some context, was this back in the
Yeah,
80s or
it's like
when?
1987. Yeah, yeah. So I bought my first investment property in '89. That gives you something. I'm dating myself here. My first property was a duplex that I actually
Okay.
moved into with my wife and son. And I was handy. I worked for a painting contractor, and then later on became a painting contractor.
Mm-hmm.
And today, my oldest son owns Van Horn Painting, which has been around 28 years now.
Oh, great.
And So at the time, I remember my father-in-law, the property had like 28 broken windows in it. And we used to do
Oh
glass.
goodness.
And my father-in-law was like, "You're not going to let my daughter live in there, are you?" And I said, "Do you want her to move back in with you?" And next thing you know, he's over there helping me put the kitchen floor in. And so that quickly turned around. But I actually later on built garages, commercial garages behind it. And I actually still own that place today. And it's
And that
been,
was like a really early house hack,
I
like
paid
decades before that became popularized.
yeah, I always tell people a house hack is nothing new. It's your grandmother's version of a boarding house. So, but I actually built commercial. I was into this kick for a while where the highest and best use of a property. How can I get more bedrooms? How can I expand this property? How can I drop a garage and rent it out on this property? All those types of ideas. And I
Hmm.
actually built commercial garages behind this duplex. And even though I paid retail back in 1989, obviously it's worth a lot more today.
Sure.
And I built some commercial garages behind it that significantly impacted the value of the property. So you never know. It's been almost 35 years almost I've owned this thing. So
Yeah.
it doesn't owe me a dime. I've refinanced it like 5 times and pulled money out.
Right.
And
That's awesome that
yeah.
you still own that original deal. I'm sure you've bought and sold other stuff in between, but it just so happened that that one had good bones, I guess, and that's one of the ones you just keep whenever you're reviewing what to trim and what not to trim, right?
Yeah.
Or maybe it's just nostalgia that keeps you there. I don't know.
One of the things I didn't realize I was doing when I was doing it, like, I had siblings and brother-in-laws and
Hmm.
all, and I was like, they all went to a job, went home, and they paid for their mortgage out of their pocket. Me, I was kind of working two jobs. I was working in construction. Later on, started my own company, and then at nights and weekends, I was doing the real estate thing. So I was handy. I had access to deals through the MLS, and I was
Hmm.
actually taking a course to get my broker's license. And the course was real estate investment. And at the time, the teacher said, "Hey, is anybody using credit cards to buy houses?" And of course, none of us were. And I
Right.
remember going home that night, and it was really just access to capital. Today, I wouldn't use credit cards. There's hard money and other things you can use. But it just changed my way of thinking. And I started, I'd buy a house with a credit card, fix it up with a credit card, move a tenant in, refinance the house, pay the credit cards off. The next thing you know, I had 400 grand in credit cards. I
Wow.
started accumulating a lot
This is
of,
back in the 90s,
yeah,
early 90s.
well, there were no fees on the cards. There was no fees on the
Hmm.
cash advances, very little. And so it was like free money for us. And I was just recycling the money. And next thing you know, I had all these lines, access to all this credit. And then my property value started to jump up. My mortgages started to get paid down. And before you knew it, I
Hmm.
had 11 lines of credit. And I was using the home equity out of the properties to buy more deals. And then I became a lender and started lending out money from my lines of credit and from my qualified plans, self-directed IRAs. And
Wow.
that's how I first got
And this was
into
your side hustle. This it sounds like
this
you're
is a
pretty
side
busy with
hustle.
it.
So I would live off my day job, my business, and then I
Hmm.
would bank my real estate commissions, and my real estate commissions became my investment money, and then it kind of snowballed from there. And one
Actually, I
thing
have
was,
a random question. What was the MLS like back then? Because nowadays everybody just like has it on their
uh,
computer and you just type in an address and get everything. How did you how did you use it back then?
it's funny when I try to say this to some people and they kind of brush it off, but when I first started in real estate, there were no computers.
Hmm.
We literally had these books that got delivered to the office that were like phone books. They were probably 6 inches thick. And you'd open up the listings and they'd have a little listing of a house and a picture and some data. And you would have to spend all day on the phone. Is that still available? Is that still available? Is that still available? Because they couldn't keep up with
Would they have
what.
to print these things every month
Oh,
or every
no,
however
they
often?
printed them every 2 weeks and they drop them off
Oh
and drop them
wow.
off. And you would get these phone books like every 2 weeks. And that was your MLS basically. And then eventually they started to come out with a computer, but it was like Atari. It was really archaic.
Hmm.
And it was the same with, I remember the beeper. The biggest thing that moved the needle for us, which is going to sound funny, was the fax machine. Because we
Right.
used we used to have to drive around. You've heard the saying "signed, sealed, and delivered." We had to go around at like 1 o'clock at night getting papers signed, or another deal could come in because you didn't have DocuSign or so.
Yep.
The fax machine was the real big thing, And then of course the beeper, and then I had a bag phone, which was outrageously expensive at the time for a bag
So you're a little
phone.
bit of a pioneer when it came to using gadgets to make your work life a little bit more efficient.
Well, today they're very accessible, the agents. I wouldn't want to be, I'm probably your worst agent today, although I sell about 300 houses a year. I'm not really the listing agent. I work with a lot of REO. I have a full-time REO staff in-house. So,
That's
um,
fantastic. And back, it seems like you dove in really quickly and quite deeply, and you're doing a bunch of real estate deals early on. Did you just figure all of that out yourself through trial and error, or did you have a mentor that kind of guided you through it, or kind of taught you the ropes a little bit?
well, I was probably what you would consider a hard-headed Irishman for the first 15 years, where I was a loner. I didn't network very well. I was very I was a realtor. I don't say I felt like a know-it-all, but I was just working in my own world. What
Hmm.
happened was I ran out of capital. So eventually I had heard about local real estate investor groups, but had never joined. And then when I got so far where I couldn't really get financing. So I go, oh, let me go to one of these meetings. And literally the first night I met a commercial friendly lender, and everything,
Hmm.
all bets were off. It was a guy out of Pittsburgh, and he freed up more capital for me than I could ever imagine, and reutilized and repositioned my equity. And, it just exploded everything at that point. And it was really about access to capital and leverage. And I think, it's funny. I had somebody ask me recently, if I was 20 years old, what would I have done differently?
Hmm.
And it was probably this leverage piece, knowing what you're good at, leveraging what you're best at, and hiring out the rest, obviously, or you know, leveraging capital or resources that can catapult you in the next 6 to 12 months or whatever. And that's one of the things my coaches have asked me over the years is, what's the one thing, or what is the, couple of the main resources that you need that's going to really game changingly, you know, catapult you personally or
Yeah.
business wise even, so it's something that you got to keep asking yourself because it evolves and it changes.
Hmm.
um, but I think it's leverage. We don't leverage resources, money, or time very well. When I was 20, I was
Sure.
into girls or whatever I was into at the time, but you get the idea.
I do. And leverage is one of those things that people have a love-hate relationship with. Some people use it incredibly efficiently and ambitiously. Other people use it to make their life more difficult, to just taking on debt. You can take on debt to amplify stuff that takes money out of your pocket, like fancy cars, fancy homes, fancy vacations, credit cards for buying stuff that depreciates, or you can take on debt that puts more money into your pocket, like buying 20 houses instead of three houses. I mean, how did you kind of focus on that kind of good debt early on versus the bad debt when so many people kind of got it the wrong way around?
This is going to sound kind of weird, but I play this game with myself where I almost don't pay for anything, and everything I pay for is paid for with something else, or it's tax deduct. It's always about a
Hmm.
tax treatment. So I really pay for very little. Mostly everything I do is some kind of a deduction of something. So it's kind of
Hmm.
funny. I always come up with creative ways to get, a free house, a free vacation home, that, my properties pay for my wife's car, or whatever. How to get college for free, how to get free insurance. I always come up with these strategies to do
Well,
that.
talk to us about how to get college for free because that's something a lot of people will be interested in.
Well, one of the things I do with my youngest son when he was ready to go to college, he's like, "Oh, are you gonna just write a check?" No, it wasn't free, but it was low cost. What he did was, he's like, "Are you and mom just gonna write a check?" And I go, "Nah, that's not kind of how we roll here. But I'll help.
Hmm.
You're gonna take a student loan out, and I'm gonna show you how to pay it back." And he's like, "What?" So even if you have the money, a student loan, I can get a student loan for my son. Well, I guess he can get a student loan, and I can get a student loan for him easier than I can get a mortgage, right? And I can also make a higher yield than what the rate of the student loan was. And I also have to, in some cases, don't have to make payments on it, or I can defer it till he's done. So there's a lot of advantages to the student loan, right? And then there's also tax deductions to the student loans. So there's a lot going on there if you can qualify for whatever it is. So he took out the student loan. I actually had my wife take out a student loan on his behalf as well. And what we did was, obviously, we were able to keep our money invested in investments that obviously make, most of our investments are north of 15-ish. So a lot of our investments are working, and I'm not pulling my money out to go pay for college, right? To me, that's
Right.
a dumb reason to pull my money out of a good investment. So, so he starts going to school, and obviously he gets done. And when he got done, imagine this, he couldn't get a job. So he came to work for PPR. Actually, he's been at PPR for about 11 years now.
Oh, wow.
He did take off. He worked, he was out in LA working. Now he's up in New York, but he still works for PPR now though. But what was interesting, you know how you have the 6-month deferral time, and it was time to pay it back. And he's like, "Hey Dad, I thought you were going to show me how to pay this back." So I go, "How much money do you have saved up?" And he had about, I think it was like 4,800 or something. And I said, "All right, let me see what we got." And we went and got a note, and the note had about 12 months on this modified second mortgage. And the payment of the note was just a hair higher than his student loan payment. So he had about a $300 a month student loan payment, and the note was comparable. So basically, he bought the note, and the payment from the note paid back the student loan for about a third of the money, because you can buy, when you're buying a reperforming junior lien, you're buying it at 35, 40 cents on the dollar, right? So that payment from that modification was paying the student loan. And he had a 10-year student loan, and it was a 12-year mod left on that note. So you see how he was able to pay his student loan back for about a third of the money. So we kind of
if he had a $60,000 student loan at 4%, and then you had a $20,000 mortgage note at 12%, one will cover the other, right?
Well, you can actually get a junior lien where, like, if he borrowed, I think at the time he had on his loan, it was only like 18 grand or something, but you could have a payoff of the note that was 18 grand that you bought for 4 grand, right? And then those payments covered your other payments. That's the beauty of that. Yes, very similar to what you're saying. You're getting a higher yield off your reperforming mortgage than you would on the debt that you're paying. And then the other piece, so that what was interesting there was his fiance went to the same school. They actually met each other. They're actually getting married this May. And nice. He always tells his future father-in-law, because she went to the same college, that he went there for a third of the money, and that always goes over well with Dad, right? So
that's true. It's good. So listen, let's rewind a bit. Talk to us about how you got involved in notes, and kind of give us some basics on what note investing is.
Well, in the very beginning, I got in the seller finance space that I learned through, like, the Donna Bowers and the Pete Fortunatos and the seller finance space. Actually, one of the first speakers I saw was Jimmy Napier, who wrote a book called Invest in Debt. And, it didn't register at first, but what I started to figure out was, if I could focus on the finance part of real estate investing, I wouldn't need to own as many houses or flip as many houses or deal with as many tenants, because the paper was more passive. And in the very beginning, I started out, if I had a rental property and I was selling it to you, I could hold a second on that property, and you could get in with very little down, basically grab the keys, cash flow. And then I'm able to cash flow off a property I no longer own. So if I structure a deal with a real estate buddy, obviously avoid the commissions, and then we can share between seller assist and me carrying a second, where they can come in with no money down, take over the properties, that type of thing. So I did a lot of that at first, and then so some owner financing, and then I was doing hard money as well. So I would do hard money lending, private money lending for fellow contractors, and then they would do it for me as well. So that it started that way. And then what I realized, I was a property manager at the time. I was at a Remax and owned a title company, things like that. And what I realized was, I was going to court weekly, and I was meeting inspectors constantly. And I was like, over here with my note portfolio, I didn't have any of that. And then I started to realize, I could see the writing on the wall. I was like, wow, this thing's taking a lot of my time. This thing's not. And this thing's thrown off a lot of passive income. And, I don't have as many headaches, and it's more scalable, things like that. So, obviously today, we have quite a bit going on loan wise. We still have properties. I mean, we get a lot of properties. We have a lot of REO
So tell us
properties.
about what you've built up over the years. You're CEO of PPR. I mean, what kind of size company is that now? How many loans have you done over the years, or how many are you trading at the moment?
It's over 9,000, I would say. It's hard to say because we used to be in the junior lien space at first, which was a lot more volume of loans. And today
Mm-hmm.
most of our capital is in first mortgages, which is a lot fewer assets. So
Mm-hmm.
the difference there is with first, you can deploy a lot more capital and your margins are less, but your workload's less.
Mm-hmm.
With junior liens, it's more touches, more workload, but a lot less capital deployed, but higher yield. Right? So it's more risk, more reward. So there's trade-offs to both, but most of
Mm-hmm.
our capital deployment today is in the first mortgage space. We do
Mm-hmm.
buy a lot from government agencies. We buy a lot of HECM loans, which are reverse mortgages with deceased borrowers from HUD. We do a lot of that. We
Wow.
all kinds of stuff. Um,
So
and
how
then
does that work for your clients? Because you have a lot of passive investors, whether it's like a doctor or a regular person who's just wants to put some of their money to work. And you're in a very, your job seems pretty complicated. I guess if you boil it down to the basics, it might not sound, but there's a lot of moving parts in what you do. So how do normal people invest with your company? What are the benefits to them of doing that?
Well, we do have a lot of high net worth folks who invest in our note funds, and we have like an income fund and we have a liquidity fund that pay different returns based on the length of time the money's tied up with us. Our income fund, which is longer term, invests primarily in non-performing mortgages, first and seconds, but primarily first.
Mm-hmm.
And in our liquidity fund, it's more of a reperforming loans, that type of thing, which are very liquid. We can sell those loans very quickly, and that's how we're able to have a liquidity fund,
Mm-hmm.
because the assets behind that are liquid. So
Okay.
that's the
So
one thing about the note business that's different than real estate. It's very liquid. Like we can sell notes in 15 minutes. We can package up huge quantities in a couple of days. Whereas houses, I can't really do that. I mean, I know you
no.
can sell your house on eBay, but I don't know that you can do a lot of it. You can.
So talk to us. I think at its basic, the way a lot of people earn money in the note business is that they buy distressed or non-performing notes and turn them into a performing note, and now it's more valuable, similar to maybe me buying a distressed house and then rehabbing it and turning it into a really nice house, and now it's worth a lot more money. Can you tell us about
Correct.
how professionals like you take a non-performing note and turn it into a performing note? Because you're buying it at a discount because the person hasn't been servicing their loan, right?
Yes. Well, it depends on the asset class,
Mm-hmm.
and well, it depends on the asset and the asset class. So there's different best exits depending on the product. So
Mm-hmm.
I'll give you an example. First mortgages, you usually exit through the property. Junior liens, your best exit is usually through the borrower, not the property, unless it's a high equity second. So that's a fundamental difference there. And then another big factor is occupancy. Like if
Mm-hmm.
I'm buying a vacant first mortgage, I'm really buying properties, right?
Right.
Yeah. So not too long ago, we purchased, I guess, about 25 million-ish of vacant first. We're really just buying properties. We're just going through the foreclosure
So
process.
you're just foreclosing on those
Yeah,
houses and
we're
then
just yeah,
moving them on.
we're really just buying properties for the most part
Mm-hmm.
at a discount. But then there's ones where you buy occupieds, a certain percentage. Um, if you bought a pool of first where, I don't know, if it's 100 first, 60, I'd say maybe, let's say 40% were vacant. The
Yep.
others of the other 60% that were occupied, half of them will become vacant by foreclosure bid.
Mm-hmm.
So that's there's no general rule of thumb, but if I had to make one up, that's about how it would shake out, right? So
Okay.
with junior liens, though, they're very statistical. So if I bought 100 junior liens that were current on their first mortgage, I
Mm-hmm.
know that I'm going to have a favorable outcome on 42 out of 100. And those 42 are going to generate all the revenue. The other ones almost don't even matter what they make. They could be worth $1.
Right.
So it's very statistical. It reminds me of when I used to sell insurance. Out of 100
Mm-hmm.
men by age 65, 36 are dead. I just can't tell you which 36 will be dead. It's the same way in the junior lien space. It's exactly the same statistical type.
Wow. So if somebody wanted to get started in the note space and they weren't, an accredited investor investing with funds like yours, if somebody just wanted to dabble in it, what type of note should they be buying to start off with? Just as I wouldn't recommend somebody buys a 100-year-old house to renovate for their first flip. What
Sure,
kind of
they'll learn a
note would
lot.
you?
They'll learn.
Yeah, they learn a lot. Yeah.
the No, we sell notes too, and our note funds are for high net worth only, but there are some crowdfunding platforms where you can invest in notes and not be a accredited investor or a high net worth investor. But we
Mm-hmm.
we do sell notes to anyone can buy a note. You don't have to be a high net worth investor to buy a note. We do sell notes. The safest notes probably when you're new or probably performing notes or notes with a lot of equity. You may prefer first mortgages over junior liens, although junior liens, you could position yourself into a deal with a small amount of money sometimes. So sometimes people, I had a buddy that started out, he bought 10 really cheap junior liens, and one of them made the bulk of his, revenue for that bucket. So it
Mm-hmm.
depends how you go about it. But the other thing you mentioned was when you're getting started, I think a lot of it has to do with your experience level, your time commitment, what you're good at. All those things are factors.
Yeah.
But I do think you need to get educated in the space, network with other folks doing it. Maybe either, I don't want to say necessarily find a mentor or coach. It would be helpful, but you could JV with somebody or shadow someone's deal until you got a feel for what you were doing. It's just like someone could shadow you with your rehab. They don't necessarily have to invest in it, but they could shadow you and follow you around and see what you were doing and learn it that way without necessarily having to put up their money. Years ago, I used to play around with options, and my youngest son was in high school, and I used to make him trade options with me, and he would put some of his money in, and he would learn what I was doing by doing that. Right. So, it's a good way to shadow is a good, safe way, I think.
I think so. So what kind of returns can you get in the note space? Because obviously getting returns on, rental properties is not that easy these days with prices as high as they are. What's it like in your space for, first position note or second position note?
Well, it's almost identical to real estate. Note values are in direct correlation to real estate values, so it's very similar that way. I have real estate deals where I've lost all my money, and I have real estate deals where I had an infinite rate of return. And I can make the same argument in the note space. But you do have up and down markets, and you have times when it's maybe easier or the margins are wider. We're starting to see the margins widen up now because up until pre-COVID, real estate values were pretty high. The market was back to where it was, and the margins were kind of small in first mortgages, just like it was hard to find a real estate deal for the typical real estate investor. The number of deals out there on the street might be thin, and you're kind of, it's a little dog eat dog going on out there trying to get a deal, right? It was kind of that way in the note space. Now it's starting to open up, and the reason it's opening up for us, we're going to be entering our really heavy buying season because the biggest economic indicator for our business is unemployment. And we have unprecedented unemployment. And the reason being is there's 4 main reasons people default, which is death, divorce, job loss, and medical. And job loss is the biggest variable one for us, whether jobs are up or down. So right now, you can get a sense that probably in the next 6 to 12 months, not everybody will be back to work. There will be some fallout, and for us, unfortunately, that'll mean more opportunity in some of our spaces. And right now we're seeing distress at the commercial level, where people's large funds, credit lines are being either pulled or tightened up. And, we're seeing securitization wind downs. We're seeing it already at the wholesale level. So it won't trickle to the retail level for a little bit, but It'll
The
be
retail
coming.
has been a bit crazy, right? Because when this pandemic caused the
Yeah.
economy to lock down in March, early March,
Yeah.
and put millions of people out of work, I certainly didn't think, I'd be talking to a guest in mid-August with stock markets and real estate prices at record highs just 5 months later. I didn't think that would be the initial reaction, but it seems to me that the real, impact on the real estate market is still to come, right? It still has to happen. It hasn't happened yet for most, unless those canaries in the coal mines that you mentioned, the office spaces, the commercials, hospitality, they're suffering, but residential hasn't really done so yet.
Well, you have a lot of stimulus. You have a lot of pent up demand from the shutdown. You also have an undersupply of housing. You have an undersupply of new construction, and you have really cheap money. The really cheap money is going to drive a lot of craziness for a while. So it'll be interesting to see. The big variable, you obviously have an election coming up. That could be a variable of
Yeah.
uncertainty. But I think best guess is this was a health crisis, not necessarily a real estate crisis. And it will probably take a health solution to get us out of it, which seems to be forthcoming as far as potential vaccines. Hopefully, God willing, we'll have one. And
Yeah.
I think by fourth quarter, you're going to see some dramatic strides back to a better normalcy. I hate that word, normalcy, these days because it's overused. But I could see where things could start to get back to closer to full employment. I think there's still going to be some unemployment. Sure, it'll be below 10. But yeah, it's hard to believe that will there all be the same number of restaurants as there was pre-COVID? I doubt it. Will people be quick to travel? Maybe not. Will people's housing needs change? We know our office needs will change.
Yep.
I always hover around 25 to 30 employees, and we quickly realized we don't need our office space at all. So you start to rethink how you're doing certain things that are going to come out of this. Some of them positive, not necessarily everything's going to be negative. There's going to be some positives that come out of how we do things going forward.
So do you foresee a surge in mortgage defaults because of the high unemployment? Is that, I mean, and obviously that's something you would be keeping a very close eye on in the space you're in. Do you think that we're going to see
Absolutely.
a lot of foreclosures coming down the pike?
I don't want to say I hope so. As far as forbearances, it was funny. I had a report today that we've only had about 20 forbearance requests, and the girl in my office was actually telling me some of the people came in. She had one lady that asked, "What are we doing?" And she said, "What are you talking about? Do you need a forbearance?" And she goes, "No, I just wanted to see what you guys were doing." So that's how crazy people are. But about half of the forbearances, they never needed them. They just are still making full payments, which is interesting. They called up to see if they could get one, and then they never took advantage of it anyway, because it's different than rent, right? Like,
Yeah.
I still have a lot of rental property, right? And if you miss 60 days in rent world, I know from property management days, you're never going to see that rent, whereas in mortgage space, it's tacked on with interest and penalties. It doesn't go away, whether I forbear it or whatever. It's not going away, right? And we're in a pretty equity market. It's not like I'm not going to recover at some point. The biggest thing for us has been moratoriums. I think about 18 states are on hold right now in the U.S., so it can hold up some foreclosure timelines or ejectment or eviction type. But it doesn't mean the asset's worthless and it went away or anything. So
No,
that's our
you
biggest.
just wonder what it would do to the market when you finally get the banks throw a ton of extra inventory. I mean, maybe it's because it's so low. There's a huge amount of inventory the markets can absorb, and it might be fine, might not impact prices at all. I mean, it just depends on the volumes that actually end up defaulting.
Yeah, I don't know that. I think it's going to be spaced out, and I think it's going to be down the road. It'll be also interesting to see if the government does anything. Right now, you still have a lot. Believe it or not, there's a lot of household formation going on as well. So it's a combination. I think that's what's keeping prices high. If you notice, like even the multifamily sector, which everybody kind of felt was in a bubble, is really still high right now. It's kind of interesting. But I don't know about retail and office space. I think that's going to be a different animal going forward for the commercial sector. And I think, this recession, whether it's started from COVID, what sector is really going to drive that the most. COVID's going to have impacts more in certain, for example, we utilize a COVID impact map, and we marry that with our foreclosure timeline and matrix, right? We have a whole foreclosure cost and timeline matrix for the whole United States, which literally varies by state and even at the county level. And we overlay that with the COVID impact map. And right now, your state of Florida, for example, is not having the greatest time, as well as Texas or Arizona. So and you saw it was New York before, right? So you can see how this wave moves around a little bit. And then there's certain industries that are tied to certain geographic locations, just like you used to have oil in Houston, not so much anymore, but you get that vibe of what I'm getting at. Certain areas have more hospitality than others, right? Some have more vacation than others. Some have more, and certain areas are going to be impacted more than, will Orlando be the same? I don't know. Maybe not.
You wonder. Yeah.
You know what I mean? Are as many people going to go there that used to go there, and maybe they will, but you get the idea. It's just going to be a different, it's yet to be seen who's impacted the most geographically, and some areas might not be impacted much at all, right? You might go to Wyoming and say, you know what, Wyoming's the same as it's always been.
Yeah, a friend of mine was in Wyoming recently, actually checking it out as a place to live. So you never know. And so what with that said, where do you think is a stable, safe place to invest in real estate at the market, given the potential uncertainty with this wave going back and forth in different markets? Is there a certain market where you think that place is always going to be very steady? Buy a multifamily in that market, buy 5 houses in that market?
Yeah, that's a great question. Yeah, Las Vegas. I think you should buy in Las Vegas. Believe it or not, it was kind of interesting. When COVID first hit, if you compare, Vegas was shut down, literally, right? And then if you compared that to San Francisco, you would have to say, well, San Francisco didn't feel it at all, and Las Vegas was getting pummeled. There's no way.
All these 9,000 bedroom hotels that had to shut down.
Yeah. So now it's a little different place today, because obviously they opened up, and will they get the same traffic though? And what kind of, or was that a good buying opportunity? Did you go into Vegas at that point and go, I'll buy whatever, because I know 3 years from now it's going to be back. That's that's a whole nother real estate play, right? So, but I believe it or not, I just I'm working on a deal right now in like some of the tertiary markets, right? And like sometimes I'll go to smaller areas. The cities that most people won't go to, not the major. Instead of going to Atlanta, do you go to Augusta instead of that kind of thing? Instead of going to Dallas, do you go somewhere else? And I think you do. I do like some of the workforce housing. I like some of the tertiary markets, because a lot of the other ones are overinflated.
I think so. I think with the affordability the tertiary markets have, the kind of low density housing that's appealing to people now that they don't like to live in high density shared amenity places, where you have so many people that might be working from home 50, 60, 80% of the time. They can live further away than they normally do because they don't need to commute as much. So all that's in the favor of these tertiary cities you're mentioning, I guess.
It changed my outlook. I was, I'm close to retirement age, and me and my wife initially were looking at like carefree living, all this stuff. We're literally going back to a property we used to own, and we're doing a high-end rehab on it. And it's a much bigger place than we need. But we're like, hey, if we got to be housebound, this is a great property, because it had a lot of, ground and a lot, and it wasn't all congested. And we're actually all excited about it now. We literally did a complete 360. We're
so
hiring.
Now you're thinking I have my cinema room here, my gym here, my pool
this is
table
gonna
over
sound this is gonna sound a little bizarre. Hopefully my wife doesn't hear it, but I'm really designing the house that she has her wing and I have my wing, and
Okay.
we meet in the kitchen basically. But you get the idea. It's cool. It's almost, and it's a lot more property and house than we need. but we figured out some things. I got a landscape package with, and some other things. And because normally I wasn't going to do that. I was going to go into a place that did everything for you. And then, but it was more density and congested. And we completely did a 360 on that.
Yeah, no, look, I totally agree with you. I live in a pretty nice, spacious house in Tampa, and my wife's family were in Madrid, living in apartments. So like 80% of people in Madrid live in apartments, even reasonably well-to-do people, and they're just not nice places if you're spending 20 hours a day at home or 23 hours a day at home. I mean, you're much better off having your own backyard, front yard, garage,
Yeah,
patio, home office, all that kind of stuff.
exactly.
you know so let me put another investment question to you, Dave, before we wrap up. If people they like real estate and they like mortgage notes, what advice do you have for them on how to balance that type of portfolio? I mean, should you be heavier on real estate when you're younger, heavier on being a note owner when you're older? What's a good balance in your opinion?
A lot of it depends on how much earned income and tax issues you have.
Mm-hmm.
So I do both, and I do want to state that highly, that I don't ever recommend do notes and don't do real estate, or do this or do that,
Mm-hmm.
because I invest in a lot of different things. I invest in businesses. I invest in a lot of different things, but I do invest in what I know. I only invest in really three categories, which are insurance related, real estate related, or lending, or banking related. So if you came to me with something else, like, hey, do you want to invest in this restaurant? I'd be like, no, or nightclub or whatever. And
Sure.
most likely I would tell you, no, I only stay in these core couple things that I know well. Now, I also invest short-term, mid-term, and long-term. And I also invest tax advantaged and non-tax advantaged. And I had a good buddy of mine, older guy, I used to manage a fund with out of San Diego. And he used to say, there's only one goal in life, Dave. That's to get as much passive income as quickly as possible by retirement at the latest, and have as much tax-free as you can. Now, you notice he didn't say what your job should be, what your passion should be, or what any of the other stuff should be. He just said,
Mm-hmm.
we should all have that same goal since fourth grade. And he goes, most people don't.
Smart way to look at
It's an
earning money.
interesting. So the sooner we all have passive investments. Now, if I have, I'm still working, I have a lot of earned income, then yes, real estate's super appealing. I mean, real estate can be appealing for certain things. I just don't like the management people side so much. I'm more on the capital side. Even to
Mm-hmm.
this day, believe it or not, you may not know this about us. We do some transactional funding, commercial lending. It would be like if you found a multifamily complex and you
Mm-hmm.
needed to raise $8 million, you could call me up. We would fund the $8 million, and we may take a piece of the GP and go right into that with you. So we do some of that. And then a lot of times we'll replace that capital with investors longer term, but we can put up capital to fund and replace later. So we do some of that stuff. I
Mm-hmm.
love transactional funding. So don't think for a minute I don't like storage and multifamily. In fact, I was involved in mobile homes and storage centers before I was raising capital for notes.
No
That was
kidding.
my job previous. So that's how
Mm-hmm.
I was. It was one of the reasons my partner that I have today reached out to me initially, because he knew I raised capital for commercial real estate, and he figured I could raise capital for notes, and that's how we started.
Mm-hmm. Another kind of exit strategy, I think, maybe I heard it from you or maybe I heard it from someone else, but if you're someone who accumulated rentals over a few decades and now maybe you own seven or eight free and clear, and you have the option of selling them with seller finance, right? And that's a nice
Yeah.
kind of retirement passive income stream for you. Is that something you've considered, or something you would recommend for people? Is it a complicated thing to do?
No, it's pretty easy to set up a note mortgage. I mean, I have a local attorney that does a lot of that for me. One of the things I've been doing lately, when it was an up real estate market, it was a little tough finding deals, like especially pre-COVID. One of the things we were doing with some of my family and friends was we were paying each other's properties off, and we were charging each other rates. And this will sound a little bizarre, but it would be like, if you were my brother-in-law, I would pay off some of your rental properties, you would pay off some of mine, and we would hold mortgages for each other. And we would do like 10-year interest only at like 7%. And you might go, well, that's absurd. But we both have life insurance on each other. So like we both have life insurance. So we have plenty of
Mm-hmm.
insurance. So it almost doesn't matter what the debt is on our property. So by having an interest only loan, it increases my cash flow. By having a
Yeah.
higher rate, it increases my write-offs.
Mm-hmm.
And then I'd rather pay you, my brother-in-law, than pay Wells Fargo the interest.
Absolutely.
And
Yeah.
you're not worried about me because we know each other, we're financial friends, and we both have plenty of insurance. So if I have 3 million in debt on my properties, but I have 5 million in insurance, do you really care when I pay this stuff off? And the answer is no. Because, and then if my heirs inherit the property, they get a stepped up basis anyway, which is actually preferable than selling the property prior to, being deceased. But
It's just a
not,
whole
not, not,
world out there that people
yeah,
aren't familiar with. I mean, the way you can move loans around the place. Some people, and I'm in this, you just have this very black and white idea of, I borrow money from a bank to do this, I borrow money from a credit card to do that. But there's so many things you can do with loans, moving them around in circles up and down, slicing them. And like you say, they're very, very liquid. That's a pretty nice thing about them. I mean, where can people, first of all, I'll say one place people can go to learn more about notes is to read your book, because you wrote a very, very good book, which, maybe plug that quickly. And then what other sources of information should people check out to educate themselves in this space?
sure. Now you mentioned I wrote a book on with Bigger Pockets called Real Estate Note Investing. That if you go to biggerpockets.com, you can obviously buy a copy of the book. Also, we answer questions on Bigger Pockets almost daily, and we have a LinkedIn group too. It's called Distressed Mortgages Group. We answer questions on in our LinkedIn group. People sell notes in the group, things like
Mm-hmm.
that. And I also, if you go to pprnoteco.com/welcome, there's actually a free ebook you can grab. It's Introduction to Note Investing as well. It's
Nice.
an introduction. It has a lot of glossary and kind of walks you through the basics if someone's just looking to check out the note business. One of the things I always say is we're all in the note business, whether we realize it or not. Most people have student loans, medical debt, auto debt, credit card debt, mortgage debt. There's a lot of debt out there. We don't pay attention to it. We just tend to use it and pay on it. We don't
Mm-hmm.
think about owning it or receiving it. So it's just a different way of looking at it.
Yeah, it's nice to be on the other side, receiving the payments instead of making the payments, right?
Exactly.
Yeah, no, I'm a big fan of that. So let me ask you before we wrap up, what news sources do you use to track real estate and the mortgage markets? What are you keeping a close eye on these days to see if the direction the wind blowing is changing? Because there's
I
a lot of
actually,
crap places out there to look at news. So what are the what are the good ones?
I actually cheat a lot, and here's how I cheat.
Mm-hmm.
I have a gentleman named Spencer Staples, who's a Market Watch forecaster, who's
Mm-hmm.
on my staff. So I actually get economic updates literally anytime I call him, but we get them weekly. Um, and he sells data actually in his other business. So he works at PPR. So I'm very spoiled. I can actually
Nice.
get really dialed in updates
Mm-hmm.
at a moment's notice. I can even call him like before this call and say, "Yo, give me the economic news that's going on right now," and he'll just boom, 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 And it's a very valuable resource for us. We're fortunate, and he's a modeling expert, and that's one of the reasons he's our portfolio. He oversees a lot of our portfolio. He's our CIO.
Mm-hmm.
So yeah, very
That's
helpful
nice.
for us.
That
Yeah.
is very helpful. We should all have
So
a, what's his name? Uh,
Spencer Staples,
we
and
should all have a Spencer in our office. Yeah.
yeah. But now not everybody has that. So what else would you use? I guess there's a lot of data from NAR, National
Mm-hmm.
Association of Realtors, that's public and free. There's
Yep.
free data and paid data. So PPR pays for a lot of data, and you can pay a lot. I mean, there's funds like mine that'll pay hundreds of thousands of dollars for data. And then, smaller real estate investors don't have those types of resources sometimes. But there's also a great book out years ago by Robert Campbell. It was called
Mm-hmm.
Timing the Real Estate Market. And really, he gives you about a half a dozen indicators that you can follow. And I've been following them probably for a good 20 or so years. And they're pretty accurate. He'll use things like, obviously for mortgage defaults and foreclosure rates and things like that. Obviously, interest rates you monitor, but interest rates are more about momentum of an up or down market, not so much what the market will be. It's more about momentum.
Mm-hmm.
But he'll look at things like housing starts. So here's an example on housing starts, which are public record, by the way. It's not like
Mm-hmm.
So I could go look at, say I'm looking in a particular county in the Tampa area, and I'm following housing starts for the last 6 months, and I see that they're going down. Well, it's really a 6 month indicator of the market's going to be declining. If I see housing starts trickling up for 6 months in a row, I'm probably heading into an up market. Is that a pretty safe assessment? Yeah, kind of. And then of course you can look at other factors in the marketplace, like job, population growth and all the, the general economy in that state or that county, right? Is population leaving Pennsylvania, or is population coming to Florida? Obviously it is, right? A lot of the southern states, you take a state like Texas, look at the growth in Austin, Texas. It's off the charts, right? It's in the top 10 cities in the US. But you can see it for business favorability. Is it favorable for a business there? Is it, jobs growth there? Is there population growth there? These are all great signs to tell you you're in a good spot or in a good market. Now, same way with us when we buy assets, right? We know whether the asset's rural. We know whether it's urban, right? We know, because if you think about it, we want to be near the general MSAs too, right? Because we know we have more buyers. Most of the first mortgages, for example, we buy are probably between 100 and 400 grand, right? They're in that bucket. Not everywhere, but there's areas that if I'm in North Jersey or Manhattan, that's not going to work, right? But or parts of California. But most markets, I have a better quality of asset if I'm buying nationwide, for example. We have buy box, right? We do the same thing everybody else does locally, even, because we want to know what assets people are going to buy. There's going to be the largest number of buyers. We're well aware of the meat on the bone we have to leave at the foreclosure bid, right? I don't know if anybody on your podcast goes to foreclosure sales. The attorney for the bank is my attorney, right? So
I'm sure they do, and that's something I bought. Most of the property I bought in the last 5 years has been in foreclosure auctions. So I mean, I'm looking forward to seeing what happens when they open up again.
They'll be busy. We could. I will tell you that. But we actually, we sell a lot of REO, and we're actually working on a platform to sell pre-REO. So I will keep you abreast of that. It might be something you'd be interested in. Yeah.
It is. Well, that's awesome. There's lots of really interesting information there, Dave. I'll dig out all those websites and notes. I'll put them in the show notes. And so what's the best way for people to get in touch with you? Is it Bigger Pockets? Is it your website? Can you just remind us of that again?
Yeah, sure. PPRNoteCo.com. You could definitely reach out to me or my team. And if you go to Bigger Pockets, we answer questions daily. Same way on our distressed mortgages group on LinkedIn, we answer questions all the time. They're probably the three main ways most people get in touch with me.
Perfect. Now I know you're very proactive and you do write a lot of interesting materials, and I would encourage people to check you out. So look, thanks again. Do absolutely reach out to me with any interesting things you hear in the Tampa market or any interesting tidbits Spencer's told you.
There you go. Absolutely.
All right, it's great talking to you, Dave. Really appreciate it.
My pleasure. Thank you so much. Take care now.
Bye. So there you have it, folks. That was show 11 of Colin Podcasts about real estate with the one and only Dave Van Horn. I've been following Dave for at least 6 or 7 years now. We've spoken on a few occasions. I've invested personally with his company. It's been a great investment, and it's something that's worth investigating. I think you should check out Loan Notes. It's an interesting way. Don't be put off by some of the terminology that was used. Obviously, Dave is an expert in it, and he throws out some terminology that might have gone over a lot of people's heads. There's ways of investing and note investing without being an expert in it. There's ways of doing it passively. It's just good to learn about how lending works. I mean, like Dave said, we're all in the note business, and if you're on one side of it with your car loans and your home loans and your credit cards, that's fine. But there's a whole other world out there, and it is something that you can get involved in for relatively small amounts. It is a nice passive income stream. It is a very liquid investment in its own right. So I thought that was an interesting guest. I thought that was a nice balance to the kind of pure real estate guests we've had before. And obviously this guy is a very big real estate investor in his own right. He's been doing it for 30 years, and there's he knows everything about it. That's for sure. So Thanks for tuning in. Hope you enjoyed it. If you are enjoying this show, be sure to leave me a rating or a review. They're very helpful to me in getting the word out. And, by all means, if you can share this link on your own social media or on your own friends that might enjoy listening to it, that would be very appreciated too. You can find me on my website, colininvestments.com. We have reports, we have podcasts, we have videos. You can get on my email list for more exclusive content. And yeah, there's lots of stuff there. I'm on all the social media sites. You'll find me on Facebook, on LinkedIn, on Twitter, on Instagram. Just look at the show notes for those links. So yeah, thanks for tuning in. I hope you enjoyed this show. And I'll be back again soon for show 12, I guess. All right, so that's it. This is Colin Murphy signing out. You guys take care. Bye-bye.